Okay, welcome back to MBA 507, Chapter 8, the Valuation and Characteristics Stock. If you, probably nice to read that little introduction at the beginning of the chapter, just to give you a feel for what can happen in the stock market with the value of stocks you may have or your company may own. And we're going to now turn over to page 260 and talk about what they call preferred stock. I'm not a big fan of the name because it causes some confusion, I think. People think preferred stock is better than common stock. The name preferred comes from the fact that the holders of preferred stock have a preference. They're in a preferred position as to receiving dividends and distribution of assets upon liquidation. So they have a preference to dividends and a preference to assets over the common shareholders in the event of a liquidation or payment of dividends. Then it could be an advantage or a disadvantage, or it could be neither. But again, a lot of writers, a lot of accountants, economists, as of the last decade and a half, and financial analysts have looked at preferred stock and are calling it a hybrid between a debt security and a equity security, because some of them claim it has some characteristics associated with bonds, but the name itself, preferred stock, means it's a stock to me. I'm not that smart. If you call something stock, it's stock. But if you want to look at the proof, the fact that it gets dividends, that means they are owners of preferred stock, are owners of the company. They have an equity position in the company. Bondholders receive interest, not dividends. The difference is interest has to be paid. Again, if the company is illiquid or or insolvent and can't pay them, but required by law to pay the interest, contractually required by the bond indenture to pay interest. Dividends are not mandatory. They're optional. They have to be declared by the board of directors. Now, preferred stock can be, we'll talk about this a little bit later on. No, we'll talk about it now. There's different features with preferred stock. It can be cumulative or non-cumulative. Cumulative means if they do not pass if the board of directors does not authorize a dividend payment, and it's cumulative, any distribution to any shareholders, common or preferred, subsequent the earlier missed dividends, which are called dividends in arrear, must be paid before any other dividends can be paid, preferred or common. So they accumulate. Okay. I'm sorry, did I say participating? I meant cumulative or non-cumulative. Cumulative, if you miss a dividend payment, you have to make it up, even if it's 2-3 years without a dividend payment. If they're quarterly, the preferred cumulative has to be paid before any other distributions are made to any other shareholders. Participating, non-participating. I got a little mixed up, wasn't concentrating. Please excuse me. If it's participating, once the preferred stockholders get their stated dividend, they will then share in any other distributions with the common shareholders. Preferred stock is usually issued with a percentage associated with its, and it'll be a percentage of its par value or stated value, which will be the amount of dividend that each share will get. 5% preferred stock would, let's say we have a par value of $100, and we get a $5 dividend each year. If you do it quarterly, that'd be $1.25 each quarter. It can be also convertible. It can be convertible into what? Can be convertible into common stock. Again, the companies that are issuing debt securities or equity securities are competing for the dollars of investors for financing purposes, and they will structure things that they think investors will want. There's a lot of investors out there with a lot of different needs and wants, so they will structure things to cater to attract as large an audience and as much interest in their stock issue, in their IPO, as they think the investor stock. So, theoretically, the higher the price you can get for it, you can maximize your proceeds from the sale. Okay. Right out the top there, they say preferred stock is often referred to as hybrid security because it has many characteristics of both common stock and bonds. Okay. It has no fixed maturity, although there are some issues lately that have a fixed maturity. So that's technically wrong. That's not too common yet, but there are companies that are doing it. If the firm fails to pay dividends, non-payment does not bring on bankruptcy, as it would with a bond. Non-payment of interest, the bondholders can bring about action to force you into bankruptcy and liquidate assets so that they can get their interest payments as well as their principal returned to them. The dividends are not deductible for tax purposes, just like they are for they're not deductible for payment to the common shareholders. Okay, interest payments to bondholders is deductible. Okay, so there's an advantage there to the issuing company that they get a deduction for the interest payments. Dividends are after-tax earnings that are distributed to owners. Okay. As it says in the next paragraph there, the amount of the dividend on preferred stock is usually a fixed dollar amount or stated as a percentage of the par value of the stock. And then they give you a couple bullet points down below on page 260. There could be multiple series of preferred stock. You could have one that's a 5% dividend, another that's a 7% dividend, and another that is an 8% dividend. You could have Class A, Class B, Class C, all with different features. Some could be cumulative, some non-cumulative, some could be participating, non-participating, what have you. Some could be convertible and others not convertible. So they would issue different classes of preferred stock. Again, giving market conditions and what interest rates are, that would explain some of the variation of the features, the characteristics. Going down those red brick colored subtitles on pages 260 and 261, you can see multiple series, claim on assets and income, cumulative dividends, protective provisions, convertibility, retirement provisions. The one that's missing there that I mentioned was participating and non-participating. Whether once they get the preferred dividend and the board of directors declared X number of dollars for other dividends, they will share in it pro rata based on the par value of the stock with the common shareholders. Okay. How do we a sinking call provision means that the company can call the stock in and redeem it or exchange it for bond or common stock or another issue of preferred. Again, if you're giving the company that privilege, the investor would want to be compensated for giving up that right that allows the company to call the stock back. So they might pay a little bit higher dividend or make it convertible to common stock if you don't want to. So they would surrender, as an investor, you would surrender it either way, but you could surrender it for common stock or for cash. A sinking fund provision requires the firm periodically set aside an amount of money for the retirement of its preferred stock. So you can see in that aspect, it's a little bit like a bond, that it will have a, if they have a sinking fund provision, then there is a maturity date for that preferred stock. Again, it's not real popular, but it is another feature that the finance people have come up with to induce people to buy that particular type of preferred stock because it appeals to them. Down the bottom of 261 and over on 262 and 3, we're going to look at something very important, how we value preferred stock. And it's very similar to how we did it with bonds. What is the value of stock? Is the future cash flows that will accrue to the owner of that preferred stock. So what do we have? We have dividends, because unless it's a preferred stock issued with the maturity or expiration date, it's going to continue like any other share of stock in perpetuity. So we're going to just look at the dividends over time. So they give us 3 steps on the page at the top of page 262. Estimate the amount and timing of the receipt of future cash flows the preferred stock is expected to provide. Morgan Stanley's preferred stock pays an annual dividend of $1.72. That's the one they're going to be using as an example in the calculations in the next couple pages. And the shares do not have a maturity date. That is, they are a perpetuity. Step 2, evaluate the riskiness of the preferred stock's future dividends and determine the investor's required rate of return. The investor's required rate of return is assumed to be equal to 6.2% for the preferred stock. And step 3, calculate the economic or intrinsic value of the Morgan Stanley share of preferred stock, which is the present value of the expected dividends discounted at the investor's required rate of return. Valuation model for a share of stock, of preferred stock, designated V subscript PSR, is therefore defined with the following formula. Preferred stock value equals the dividend in year 1 divided by 1 plus the required rate of return plus the dividend in year 2 divided by 1 plus the required rate of return to the second power. And for the third year, it would be the dividend in year 3 divided by 1 plus required rate of return cubed, or to the third party. And as you go out each year, you would rise whatever the period, whatever year it is in, that's what you would raise the denominator in that formula to. 1 plus required rate of return to the nth power, n being equal to the year you're in. Now, you might say, well, if it's preferred stock is perpetuity, it goes on forever and ever and ever. But as you get out in time, after 40 or 50 years, the mathematics involved would have it be very, very little. You can see there on the last line, just above that finance at work box on page 260, that the last, they have the ... dividend in infinity. And they even have the infinity sign subscript on the dividend and as the power for the parentheses of 1 plus the required rate of return. That thing would be so small, it would not have any impact on the price. Remember, here in America, our stocks are quoted in dollars and cents. So once you get to the third decimal, or the third decimal could be rounded up or down, but the fourth decimal is immaterial. Okay, we're going to continue over on page 263, the top here, plug in some numbers in with that formula. And you could see the $1.72 is a preferred dividend, and we divide that by the required rate of return of 1 plus, or here it's the required rate of return by itself is 6.2% or 0.062. Divide that into the dividend and you get $27.74. Okay. The difference between formula 8.1, that's in the parentheses on the right hand of those formulas, and 8.2 is because the dividends in each period are equal to for preferred stock, we can reduce the following relationship. And they revise that formula to just the dividends divided by the required rate of return. Okay, because they're constant. They would then walk you through an example, so you can follow that on pages 263 and 264. But before we turn over to that, I'd like to call your attention to the bottom half of page 262, the blue box entitled Finance at Work, reading a stock quote in the Wall Street Journal. If you've ever opened up the Wall Street Journal, or I guess most of it's online anymore, they have news articles, regular news articles, but then in the one section, they have page after page after page with a symbol number or the symbol for a given stock, and then they have all these columns, 1, 2, 3, 1, describing the current price, the high for the last year, the low price for the last year, the dividend yield, and the price earnings ratio, and the year-to-date percentage change. So this will give you a little bit of hint that, there's two tables they have there towards the bottom of that box are abstracts from a Wall Street Journal. And who are they using here? WMT. I think that might be Walmart, but I'm not sure. Okay. There's a symbol, and then you can, it tells you how to interpret what those columns are. So it might behoove you to look at that, or even go online or pick up a hard copy of the Wall Street Journal. I don't know what it's, I guess it goes for $1, $1.50 now, just to have and read it. Back when I was a traveling auditor and I'd be away from home every third or fourth week for a week at a time, certain hotels that cater to business travelers would give you a complimentary copy every morning. And around the country, the major cities had different editions of it. Okay. Common stock. Again, it's an ownership investment in a corporation, just like preferred stock, but it's a little bit different. Common stock holders have a little bit more risk than a preferred shareholder, because the preferred shareholders, by definition, have a preference to distributions of earnings, i.e. dividends, and the claim on assets in the event of a liquidation. And even, let's go back to Chapter 7 and look at bonds. Bondholders are even less risky position because being creditors, they move to the head of the line in the event of a corporate liquidation, and interest has to be paid before any dividends can be paid. In fact, that is usually in most jurisdictions, the 46 states and the 4 commonwealths, as well as our territories, usually have a law that you cannot pay dividends if you've missed an interest payment. Okay, so common stock. If you have shares, you get one sheet of paper, a certificate that says you own shares. You don't get a sheet of paper, a certificate for every share. But they go over some of the rights here. You're an owner, so you have a claim on the assets. After the creditors are satisfied and after the preferred stockholders are satisfied on their claims, then you can claim what's ever left because you're an owner. But again, that's the risk you take for buying a common stock. Of course, our one principle, the bigger the risk requires reward. The common shareholder will be rewarded more than the preferred and the bondholder. Okay. The nice factor about corporations is that they give the owners a liability limit on their liability. You're limited to the amount you've invested in the company. Unlike a proprietorship or a partnership where they can come after the individual proprietor or individual partners, joint or severally, for satisfaction of any debts of the entity, the corporation provides a shield of protection that they can't come after your personal assets for satisfying any debts or liabilities of the corporation. You can only lose as much as you've invested. Now, being an owner, you have voting rights. You have a right to elect or to cast a vote for the board of directors, The board of directors then hires and fires and directs management. In theory, you'll see in my highlights that usually in practice, it is just the opposite. Management usually controls or dictates to the board of directors. The board of directors just acts as a reviewer, overseer, and unless things get contentious, then they can fire management. But usually management has a lot of shares, and they can vote their shares to the members of the board of directors they want to sit on the board of directors, and usually there's a close relationship, working relationships. Okay, so a proxy gives you the right to designate someone else to vote your shares, and that is again what management often does. If you own shares, you'll be receiving a letter asking you to give them the right to cast your vote for the board of director candidates. Under majority voting, each share of stock allows the shareholder one vote, and each position on the board of directors is voted on separately. With cumulative voting, each share of stock allows the stockholder a number of votes equal to the number of directors being elected. Okay, so if there's 4 people up for the board this year, I can cast my 4 votes for one person. I can cast one of my 4 votes for each of the 4, or I can cast 3 votes for one and 1 vote for another and leave the other 2 out to dry, or any combination thereof. The preemptive right. This is important because what the preemptive right does, it allows you to keep your ownership percentage. Should there be a new issue of stock, another IPO, or another class of stock issued, existing shareholders have the right to purchase a number of shares required to keep their ownership percentage the same after the sale of the IPO, issuance of the IPO. All right. You don't have to do, it's sort of like the right of first refusal, if you're familiar with that. Okay. Valuing common stock. Again, no big thing here. Is we're looking at the cash flows over time, over the holding period. What's somebody's required rate of return? What are the dividends? The thing with common stock is the dividends from time to time are increased if the company is doing well and earnings are growing. So we have to put in a growth factor on the formula we saw for the preferred stock. Formula is very similar, but we have to put in the growth rate. Okay. Down the bottom, okay, the return on equity formula down the bottom of page 268. You take a look at that. Up on the top of 269, the dividend growth model, give us the formula equation 8-4. Value of common stock is the sum of the dividends from in year 1 when you first acquire the stock divided by 1 plus the rate of return to the power equal to the year you're in. You can see they do that dividend in year 2. That's a capital D in the numerator of that formula, over 1 plus the rate of return on the common stock squared in year 2. For year 3, it'd be up to 3. And they take it out to year N and then out to infinity. And again, once you get past 40 or 50 years down the road, the mathematics involved will reduce that thing to thousandths or hundreds of thousandths or even a millionth of a cent. And we're looking to get a value in dollars and pennies. So they give us an example here of down about 2/3 of the way down 269 is where they modify that valuation model, common stock equation 8-5, where you have dividend in the year divided by the required rate of return minus the growth rate. Okay. So if you're mathematically inclined, you can look at the bottom third of that page 269. If not, it might confuse you. So just go with that equation 8-5. And that is what they do over on page 70. I'm sorry, page 270 in the middle of the page. We have a $2 dividend. We have the required rate of return is 14%, and the expected growth rate is 4%. So you can see their dividend subscript 1 year 1 equals the dividend the next dividend to be received times 1 plus the growth rate. So you have $2 times 1 plus the 4% rate of growth. So that means the dividend goes from $2 to $2.08. So now we have a two-step process here. Number 2, using equation 8.5, we now have the dividend as $2.08 divided by the required rate of return of 14% minus the rate of growth. You do the math on that, and it'll come out to a value of that capital stock of $20.80. Okay. Right underneath that calculation, they have a nice sentence there. We have argued that the value of common stock is equal to the present value of all future dividends, which is without a question a fundamental premise of finance. In practice, however, managers, along with many security analysts, often talk about the relationship between stock value and the earnings rather than dividends. I have an article that I'll read to you later on in a separate video about valuation of stock. This formula they give is a basic, commonly used one. It is not the only one. In fact, when I teach one of my forensic accounting courses, and we're looking at selling a business, how do you value a business? Well, it depends. There's various ways. You can value it based on its earnings potential. You can base it on its asset base. You can base it on a number of things, and we'll see that later on in the other video. But for this is an introductory level finance course on the graduate level, and we're just going to go with this widely commonly used formula for valuing common stock. Again, we see it repeated up on the top of page 271, again, because they're giving us example 8.2. So they use a Nike company in 2017, and they give you some facts there. So you can look at that, read it at your leisure, or walk through it with your calculator and a sheet of paper and see where they're getting the numbers for what each number is. You know, they have an 80-cent dividend. Now, here's the thing. Some of you might be thinking, hey, there are some companies that don't pay any dividends, right? There are some companies that pay very little dividend. Well, obviously, in that case, this formula is not very useful or very indicative of the underlying value of the stock. Steve Jobs, the founder of Apple, did not like dividends. Warren Buffett does not like dividends. Henry Ford, I read his autobiography about 3-4 summers ago, back in the turn of early 1900s, when he went public with this company. He did not like dividends. Think about it, what dividends do. Dividends take assets out of the company, usually in the form of cash. Some companies do give in-kind dividends. We're talking finance. There's two ways you can finance a company, by borrowing money or by owners' contributions. Well, owners have a claim on earnings. They want all but one of the companies I'm invested in, I have my dividends reinvested. I don't want them. I don't need them. I don't need the cash flow. And think about it. What dividends are doing? I'm plowing it back in. I want them. When a company let's say a company makes $10 million and they say, we're going to keep $7 million in retained earnings, and we're going to distribute $3 million of our earnings, current year earnings, to our shareholders in the form of a dividend. Well, that's $3 million less that the company has. As a shareholder, you'd say, why? You're no better off nor worse off, because if that other $3 million, between $7 million and $10 million, is left in the company, you own part of that. The only difference is it's in the corporation's checking account. When they pay the dividend, it's in your checking account. Now, you can sit on it, you can spend it, or you can buy more dividends of the same company or some other company if you want to diversify. But think about it. It's not a change in your wealth. It's just a matter of what pocket, what checking account that $3 million is in. It's the cheapest way of financing is using retained earnings. They don't have to pay dividends. They don't have to pay interest. So why not use all the earnings of the company to plow back in, reinvest, and grow the company? Again, I've mentioned this several times using the example of Hershey Foods. I was fortunate to buy it 20 years ago or so, maybe more, 25. And it's been a very good investment for me. And I don't care what I own as far as raw materials and machinery and all. I worry about the cash flow. It's how it's increasing my net worth. And, over the years, I think current dividends like $2.75 a year, maybe $3 now. They may have upped it. But between the beginning of this year and now, it's gone up about $25 in market value. What would you rather have, $2.75 in dividends a share? Or would you rather have the value of the share go up $25? So you can see the capital gains, the market appreciation and the value of a stock is where you really increase your wealth as a shareholder, as an investor. The dividends, why they pay dividends is because people want to get a return. They want to see that they're getting something. Well, they're short-sighted because they could get a lot more if they left that dividend, told the company, don't give me a dividend, you guys use it, or you gals use it, you guys and gals use it, trying to be politically correct here, to invest and grow the company. And look at your return on equity, return on assets. If that's higher than your dividend rate, you're better off, way better off. Okay, so they give you an example on valuing Nike here. They said in 2017, selling between $50 and $73. Most recently, it was selling at as high as $73. Recent earnings per share was $2.31, and the dividend is 80 cents. So, my calculator, I should be able to do that in my head. So it'd be $1.51 is kept in the company as retained earnings, and 80 cents is returned. Let's see if that's right. What did I say? $1.51 plus 0.8. Yes, $2.31. I didn't need a calculator. The company's return on equity has been 22%. You're investing 100 shares of stock. You want a 16% return on your investment. Again, these formulas, you got the three components: the value, the rate of return, and the dividend. You can change these variables, and you can solve for any one. If you know 2 or 3 of the variables, you can solve for the other one. So this is a little bit different thing. As you know what it's selling for, but you're looking at what do I need as a rate of return as an investor? What will I be willing to pay for it? Might be good for people that are trying to that are market timers. So they say, look at the growth equal the rate of return times the projected growth rate there, and over in step 2, the value. We're trying to figure out what the value is that we would be willing to pay for it. So we know the dividend is 80 cents. We know our required rate of return is 16%. That's the denominator. And then we minus out the return on equity was 14.4. Let's see. Yeah, the firm's return on equity is 22. We could expect the company to grow at 14.4. So that's a growth rate. So you do the math there, and it comes out a value of $50 would give you your required rate of return of what are you looking for? 16%. So if you pay over $50, you're going to get less than your 16% rate of return. If you buy it less than $50, you're going to get more than a 16% rate of return. Okay. All right. Expected rate of return of stockholders. And again, I'm skipping over the financial decision toolbox and to get it. You guys can do that on your own. Again, the financial decision tool things, don't worry about the formulas. Be more focused on what it tells you, the right-hand column. because that is important. You can always get somebody like me or some to crank the numbers for you. You're in a company, if you're not in the finance area, but you've got to be making decisions, you're going to get the numbers from somebody else. You're going to have them crank them out for you. Okay. Also, I think at the beginning of the chapter was remember your principles. There's another one here on page 272. Cash flows what matter. Money has a time value and risk and reward. Very important, very relative to valuing stock. They give us a couple examples here, walking us through the expected rate of return for a preferred shareholder. Again, preferreds are easier because the dividend is fixed. Common stock, we have to introduce we have to take into consideration the growth factor. So we can modify that, which I think they will do in a couple pages. Again, it might be a little intimidating or scary, but if you take your time, they give you the formulas in words and then symbols, and then finally plug in some numbers there. So towards the bottom of page 273, we have the value of the preferred stock is the dividend divided by the required rate of return stock price, and there's 364 divided by 50. It comes out to 7.28 required rate of return. Okay. And again, it looks like it's using the example of, is that the example of, no, that's not Nike, because Nike had a different dividend. Okay. Do they say what company here? Yeah, it's not important. Okay. Again, you can switch around looking, the dividends will always be available. The stock market price is a variable depending on the rate of return you are looking for as an investor. So you can say, hey, I want a 12% rate of return or 15%, and then you plug that in using that formula and seeing what the price you should pay or would be willing to pay to get that type of return. Or you can get the price or you can get the rate of return you want and figure out the price you want to pay for it, or vice versa. Again, of those variables, the dividends are going to be unknown. So we're either looking for the rate of return or the value of the share of stock. Again, they talk about the preferred stock, then they talk about the common stock. And again, we've got to factor in the growth rate. And they go back to the example of Nike there. So again, top of 276, the three-step approach, rate of return, dividend in the year, divided by the market price plus the growth rate. And you can walk yourself through that and see where they come out with the 15.5%. And then the conclusion. I'm a numbers person, so I'm interested in the numbers, but the numbers are only the beginning of the story. It's how you use those numbers, and that would be step 3, analyzing results. At the current market price of $73, investing in Nike would not satisfy your 16% rate of return. And again, we could plug that $73 into the formula and work backwards and see what the rate of return would be. That's what they did do there, 15.5%. Okay, down the bottom of 276, again, they give us financial decision tools. Again, concentrate on what it tells you, columns. You can ignore the formulas. You can always go back to your textbook or online and get the formulas. And again, probably you're going to get somebody in the company or your CPA firm to run the numbers for you. The thing is knowing what those numbers mean. All right. Oh, it was a nice, short, fairly straightforward chapter. So enjoy reading it. As I advise all my classes to do, read it more than once. Okay. Especially if the first time you read it, it might be the first time you're coming across some of these terms and concepts. So read the chapter, look at the PowerPoints, read the chapter again, watch the video, maybe read the chapter again. And again, the second, third time you read it, you can read it a lot faster. You don't have to concentrate as much because it's not as foreign to you. Okay, I'm going to shut this down, and then I'm going to do the other thing, which is just reading an article about the Bank of America evaluating their stock.